Swayam Prabha. Digital India. Educated India.
Real Estate Portfolio Management Basics. As part of the course, Real Estate Finance and Investment Strategies will be today's topic for the class. First, we will look at the learning objectives which we will try to achieve in this particular class. The fundamental principles of real estate portfolio management, key diversification strategies for real estate investments, asset allocation methodologies and their application, portfolio construction techniques and implementation challenges, performance measurement and optimization approaches, technology tools supporting portfolio management decisions, practical application in the Indian real estate context. Now first, what is real estate portfolio management? So, the strategic oversight and administration of multiple real estate assets to achieve investment objectives while managing risk through diversification. So, we have seen this earlier, that the basic concept that don't keep all your eggs in the same basket. We have seen that when we were talking about REIT, or when we are talking about any investor, they should not, invest too much into maybe one specific geography, one specific property type. So that kind of diversification we are understanding. Now, when we are having these multiple different types of properties together and all these combinations, and in finance in general, when we have different type of investment assets together, they form a portfolio. So here we will be focusing on real estate portfolio management. So first, let's start with clear definition, which we have just seen. So the key distinction here is property management focuses on optimizing individual assets, ensuring high occupancy, maintaining the property, maximizing rents for that specific building. Portfolio management, however, focuses on the collective performance and strategic allocation across all your assets. So think of it in this way. Property management asks, how can I make this building perform better? Portfolio management asks, how should I allocate capital across different type of properties, locations and strategies to achieve my overall investment goal. So on the one hand, property manager is focusing on individual assets optimization to improve that, how well it can work. On the other hand, a portfolio manager would look at the maximization of profit through a particular portfolio of real estate properties. So in Indian context, we have seen remarkable evolution. Traditionally, real estate investment was about buying individual properties, often driven by emotional factors or limited market knowledge. But following economic liberalization, and especially after the introduction of REIT, we are seeing a transformation towards more institutional strategic approaches. This shift is basically creating a better outcome for investors who embrace portfolio thinking. So before REIT, or before this kind of rapid introduction of IT based solutions, before that it was mostly focusing on emotions and then investing, or investing on, whether you feel like a particular area will give you returns. Still many people trade, invest in real estate like that, where they have heard something, or some project is about to come, or some property will increase prices after this project will come in. So that kind of simplistic analysis is definitely still there, but now proper analysis using simulation models, which we have seen earlier, and assessing the risk, all that has come in because of this institutionalization of this real estate, and how the foreign money is also now coming in. So why portfolio management matters? So one of the first aspect we have seen, that don't keep all your eggs in the same basket. So risk mitigation is a very big important idea. And then return optimization is also there, that you should make good profit on your investment, and the return which comes through diversified properties, that kind of approach we have to adopt here. And so strategically allocating that will enhance our overall performance. And then capital efficiency, so improved deployment of investment capital, so that we can achieve. And then income stability, that diversification maintains steady cash flow. So maybe we will not get very high return, but at least we will have decent return, and we are much more we feel much more safer about it, because we have followed all the risk analysis, and then we have created this portfolio. And then wealth preservation, protection during market downturn. So properties which are not correlated with each other, when they come together in a portfolio, that will ensure that even in downturn we will have some return, which might not be the case for a concentrated property allocation. And then in Indian context, we understand that heterogeneous market across cities, varying regulatory environment, and significant price disparities make portfolio approach essential, because we have these so many different local laws, central laws, and also the micro markets are so much isolated from each other many times, that we can have this portfolio approach, and it is becoming actually very, very essential in India. Then we have risk return spectrum in real estate. So we can see that different investment strategies we have. So whether it is your core investment, core plus, value add. So let's see. So understanding this risk return spectrum is fundamental to portfolio construction. Core investment represent the lowest risk category, with the expected IRR of 10 to 14% and high income stability. These are typically grade A office building in established business districts with long-term credit-worthy tenants. Then we have core plus investment, steps up the risk slightly to lower medium levels, targeting 12 to 16% IRR with medium high income stability. These might be good quality properties that need minor improvements or are in emerging but established markets. Then we have value add investment, which requires medium risk tolerance and target 15 to 20% IRR with medium income stability. These are property requiring significant improvement, lease up or repositioning. Then we have opportunistic investments, are high risk strategies targeting 20 to 25% IRR, but with low income stability. And then development represents the highest risk category with expected return of 25%, but no income during the development phase. So these are ground up construction projects with highest risk but potentially the highest returns. This spectrum is crucial because different investors should have different allocation across these categories based on their risk tolerance. return objectives and investment horizon. A pension fund will weigh heavily towards core, while a private equity firm might focus on opportunistic and development. Then we have investment objectives framework. Before constructing any portfolio, you must clearly define your investment objectives and understand your constraints. So let's examine both sides of this framework. We have primary objectives, including 5 key areas: capital preservation, protecting your initial investment, regular income generation, creating steady cash flow, capital appreciation, growing the value of your asset over time, tax efficiency, maximizing after-tax return, and inflation hedging, protecting purchasing power over time. Then key constraints, we have liquidity requirements, we have time horizon, we have regulatory restrictions, and capital availability and management capabilities. So basically primary objectives are there, and then we have key constraints, and these objectives and constraints work together to define your investment profile, which then drives all subsequent portfolio decisions. Getting this framework right at the beginning is crucial for long-term success. So, diversification, the foundation. Basically, the first point, don't put all your eggs in one basket. So, property type diversification should be there. Geographical diversification if possible, in different geographies, different office, retail, this kind of diversification. Investment strategy diversification, whether it is core, core plus, value. Then we have tenant diversification. Instead of having one single tenant occupying a mall, there should be multiple your tenants, or in your office building, multiple tenants will be better from different company, different industries should be better than from a single industry. For example, depending only on IT sector, and IT sector, if it goes in downturn, then you will face difficulty. And then you have vintage year diversification also, so that can be seen. So there are, different ways in which you can look at the diversification. It's not just a single way to look at it. Then also we have seen that when we talk about vintage year diversification, we should spread investment timing across different market cycle, not just at top of the boom, or if we are perceiving that this is the end of the bear market, maybe there is much more time for market to recover. So instead of just fixing one particular time, we should scatter our investments also. So that timing also we should try to look at. So in every which way possible, we should try to diversify. That is the core idea here. Then property type diversification, like I said, can be your different commercial segment from office to data center. We have discussed earlier that we should distribute amongst them. Residential segment, if we are talking about, then from affordable to super luxury. So there are different markets altogether. Then coming to COVID-19 impact we have seen in property. So office was the most negatively hit, where we are still feeling the impact of it. When this actually happened, COVID, at that time, when the REIT managements were asked about the impact on the REIT occupancy level, so it was assumed that because there is a longer lease term, and in few years this impact will be over, and everyone will come back to the offices, and the things will go back to the normal situation where they were earlier, and the occupancy will actually rise up. Even though the occupancy have risen, but still the physical occupancy, where the employees are actually coming back to the office and attending their offices is still low, because many these REITs are having tenants from IT industry, and there you see that many employees are still working from home. So there is a significant proportion of that, and so physical occupancy is still not visible in many such offices. So basically, offices was the most hurt, you can say, during COVID-19. Residential was mixed. There was recovery in mid 2021 and preference for larger homes, because people realized that they will require secluded spaces to attend their meeting online. And then retail also, it was highly negative for that period, because there was no shopping allowed, there was social distancing, and that was felt by retailer. And industrial logistics, it was positive, because e-commerce was appreciated, and the rules were there to encourage it. So more and more logistic hub points or warehouses were required. So it was positive for this sector. And data centers, of course, because of the higher IT internet demand, it was data center was also at the fast growing at that time. So, and still very fast growing. So that is how the COVID-19 impacted different property types. So if we had a combination of different property types in our portfolio, our return would have been much more stabler in comparison to somebody maybe who has invested fully in office or maybe retail. Then geographical diversification from tier 1 to tier 2 cities. We have seen even during COVID time, some cities were majorly impacted in comparison to other cities. There were variation in rules also. And even in your normal days, we see that some cities have different local laws in comparison to others. So there can be, if all the properties which we own are in a single city or in a single region, that may be, that can impact. And this is something which is talked about REIT also, that most of their underlying properties are basically in these few cities like Bengaluru, Mumbai. So they are also concentrated in that sense. Then market correlation analysis. We should also understand this, that correlation is an important thing. That if there is a lower correlation, for example, Mumbai and Hyderabad, we can see that there is a lower correlation amongst them. So Mumbai properties and Hyderabad properties not move in the same direction together. There is a disconnect between them, and for portfolio that is good, because if you are buying a property in Mumbai, or if you are buying property in some other city which has having similar correlation, which is very high correlation with Mumbai, then in that case there is not much diversification in your portfolio. So this kind of correlation also must be seen when we are investing in different cities. So for an institutional investor, like for example REIT, where they are owning their business is owning and operating grade A offices, they can actually plan according to these correlation matrices. Then strategic asset allocation. We have two: strategic versus tactical allocation. So we should look at this, that we have two approaches. One is your strategic asset allocation, SAA, and we have tactical asset allocation, TEA. Strategic asset allocation represents your long-term allocation for 5+ years. These are based on fundamental investment objectives and remain relatively stable over time. SAA drives the majority of your long-term return and typically involves lower transaction costs, because you are not constantly adjusting. Think of SAA as your portfolio DNA. It reflects your core belief about different markets and strategies and shouldn't change frequently based on short-term market movements. On the other side, we have tactical asset allocation. which involves short-term adjustments over 1 to 3 years based on market opportunity or risk or identify. Basically risk you identify. So on that basis you do. There are more frequent adjustments that can enhance returns but involve high transaction cost and active management. For example, your SAA might target 40% office properties, but through TA you might temporarily increase to 45% if you see compelling opportunities in the office market, then rebalancing back to 40% over time. So the key insight is that SAA typically drives 70 to 80% of long-term performance, while TEA can add value around the margins. Many investors make the mistake of focusing too much on tactical moves while neglecting the strategic foundation. In real estate, given the high transaction cost and illiquidity, SAA becomes even more important because tactical adjustments are expensive and time consuming to implement. Then we have sample strategic allocation by risk profile. So this table shows how strategic allocation should vary based on investor risk profile. So if you are a conservative or balanced or aggressive, that is how your strategy will change. So conservative investor should allocate 70 to 80% to the core, 15 to 25% to core plus, and 5 to 10% to to value add, and 0 to 5% to opportunistic, and nothing to development. This profile prioritizes capital preservation and stable income. Balanced investor can reduce core allocation to 40 to 60%, increase core plus to 20 to 30%, and value add to 5 to 15 to 25%, and opportunistic to 5 to 15%. This profile seeks moderate growth, but aggressive investor, you can see the development, which is the most riskiest property type, they are putting in 10 to 20%, and in core also they are putting 10 to 30%. So you can understand that how much aggressive that this portfolio can be. It can be very risky because this is the most riskiest kind of property investment. Then similarly, other rates, also strategies also, you can see that they are putting more money towards the riskier propositions, right? But that is upon the kind of risk profile a particular investor has. Then real estate in multi-asset portfolio. So up till now we have discussed that we can have different properties combined together from different types of properties or from different geographies of property, and we can approach different investment strategies. But there can be a portfolio of different type of investment vehicles also. So real estate can become part of the different assets, such as, for example, gold. There can be gold in particular portfolio. There can be equity in a portfolio along with real estate. Then there can be gold. There can be international equities. So there can be a combination of plethora of these different type of asset classes. You can combine them together, and the idea here is that if we are adding any, we should know the correlation amongst them. So for example, here we can see that these asset classes correlation with real estate. Now this may be not exactly this in a particular city, but this is the overall Indian trend we have observed, and this is from 2015 to 2003. But this can change, but this may be a reflection of what kind of correlation we can see with real estate. And you will see that generally it is low for all of them, and for gold it is even very, very small. So this kind of correlation will help you identify those asset classes which you can add along with real estate. Then going for the portfolio construction approach. So there are two primary approaches. One is your top-down approach and other one is your bottom-up approach. So in top-down approach, you will go for from top, that is from macroeconomic analysis, to the lowest from property selection. On the other side, you will first look at the property screening. You want to look at a particular property you want to invest in, you will directly look towards that side. On the other side, for example, maybe a foreign investor who has option for multiple investment in different countries, they may come and they will look at the macroeconomic conditions of various countries, or maybe if they are looking at India, at different regions. So macroeconomic analysis will be done like that. Then market sector selection will be decided, and after that micro market selection will be made, that a specific market, say for example, they in India they have decided to invest in Hyderabad. Then in Hyderabad, in which micro market they want to invest. So that kind of from top to bottom they are coming, and then ultimately in what property they would like to invest. So this kind of approach is your top-down approach. And in bottom-up approach, first property screening is done, then deal analysis, what kind of offer is there, then whether adding that property in your portfolio is better or strategically useful for you or not. So that kind of analysis, and after that execution and integration will be done. Once you have decided that we want to invest, then you will execute that and integrate it into your portfolio. So that difference in approach is also there. Practical application will be that most successful investor combine both approaches for optimal results. So you can look a problem from both the sides. That is not wrong. You can approach it from both the ways, whether you want to go for a top down approach or you want to actually analyze from bottom up. Then coming to core satellite strategy. So in core satellite strategy provides an elegant framework for balancing stability with opportunity in real estate portfolio. Core component should represent 60 to 80% of your portfolio and consist of stable income producing properties with lower volatility and predictable cash flow. Example include grade A office in established business districts, high quality retail properties with creditworthy tenants, or well located residential properties with strong rental demand. Then we have satellite components represents 20 to 40% of portfolio in this and include higher risk, higher potential opportunities like value add, opportunistic investments. Example include development projects, distressed assets requiring repositioning, or properties in emerging markets with high growth potential. This strategy provides multiple benefits. The core holdings provide portfolio stability, predictable income, and reducing volatility. The satellite holding it provides enhanced return potential and exposure to special opportunities that can significantly boost overall performance. So core, where you getting the stability, and satellite, where you are getting the growth. So you are combining stability with growth to have a core satellite strategy and try to maximize return in your portfolio. Then factor based portfolio construction. So we have growth factor, properties in high employment growth areas. We have income factors, quality factor, value factor, and infrastructure factor. So in this type of approach, we can identify like for example, in growth factor focuses on property in high employment growth areas, location benefiting from new corporate relocations, infrastructure development, or demographic expansions. The income factor target properties with high current yield, assets that generate superior cash flow relative to acquisition cost. The quality factor emphasizes grade A properties with superior specifications and institutional quality characteristics. And then we have value factors, which seeks properties trading below intrinsic value assets where market price doesn't reflect the underlying worth, and often maybe because temporary market conditions are there or seller distress is there. And then infrastructure factor, which targets properties benefiting from new infrastructure development like metro line, highway connection, airport expansion or IT corridor development. Implementation basically involves systematic weighting properties with favorable factor exposures. For example, if you believe the growth factor will outperform, you allocate more capital to properties in high growth employment areas. This approach provides systematic framework for investment decisions rather than relying purely on intuition or ad hoc opportunities. So it helps ensure your portfolio benefit from structural themes you believe will drive returns over time. Then we have performance measurement metrics. So performance measurement in real estate requires multiple metrics because single measure can be misleading, giving real estate's unique characteristics. So return metrics start with total return, which includes income return plus capital return. So for REIT, we use total return because there is a income which is generated through dividend yield, and then there is a capital we are getting from the improvement in price. So the appreciation of the REIT prices. So there also we use total return. Then we have IRR, which accounts for timing of cash flows. Crucial in real estate given irregular cash flow patterns. Then we have equity multiple, which is simply total cash received divided by total equity invested, a simple but effective measure of total return magnitude. And then we have risk adjusted metrics we have seen earlier, Sharpe ratio or Sortino ratio, return minus risk free rate divided by volatility for Sharpe ratio, and return minus risk free rate for and divided by downside deviation. So for Sortino. So then we have risk metrics, we have standard deviation, which is telling us the volatility, and then maximum drawdown to understand worst case scenarios, and occupancy volatility to measure income stability of a particular property. So the key insight is that no single metric tells the complete story. You need to evaluate return, risk adjusted returns and risk measures together to understand portfolio performance. Different metrics may suggest different conclusions, so comprehensive measurement is essential. A practical application would be that you track multiple metrics over time and compare against the benchmarks and peer groups to understand whether your portfolio is truly performing well or it is not. Then benchmarking challenges in India. So we have available indices include NHB Residex, that is residential prices, right? For we have RBI Housing Price Index, we have Knight Frank Property Index, and JLL City Momentum Index. Now there are limitations. Limitation is that it include limited historical data. Most indices only have 5 to 10 years of data, making long-term analysis difficult. There is primarily residential focus with limited commercial property coverage, and methodological challenges arise from heterogeneous nature of real estate market. And then there is publication lags, means data is often 3 to 6 months old when released, limiting usefulness for active management decisions. The practical solution many institutional investors use is to create custom benchmarks based on peer groups and synthetic portfolios. So this involves working with other investors to share anonymized performance data or constructing theoretical portfolios with other investors to, you know, for this and based on the market transactions which are there. While imperfect this system may be, but custom benchmark provides more relevant comparison points than generic indices that may not reflect your specific investment strategy or market focus. So this benchmarking challenge highlights the importance of absolute return focus in real estate rather than purely relative performance measurement. So many times you will see that absolute return focus is there instead of relative because of this absence of benchmarking, which even if there is a benchmark available, you cannot rely on it much because you have just seen that data is not that old. 5 to 10 years is the history of these, and most of the times their publication happens after 3-4 months. By that time you will not be able to the ground realities changes. So that is the issue with them. So custom benchmarking can be used. Then technology in portfolio management. So property management systems like MRI software, Yardi, Voyager and India specific platforms like Build Supply handle day-to-day operations but also generate data for portfolio analysis. So there are methods, RealPage, Homogeny Pro. So basically there are multiple options available. You will find out more if you will search the property management softwares. Portfolio analytical platforms provide performance attribution analysis, understanding which decisions drove returns. They offer risk assessment and monitoring capabilities, forecasting and scenario analysis, and investment optimization tools. And then there we have emerging technologies in the form of AI ML for rental prediction and tenant analysis, IoT for smart building management, and blockchain for transaction records. Now let's take one case study for family office portfolio. So 200 crore allocation over 3 years. Strategic allocation, commercial office of 40%, residential of 25% and retail 15%, industrial logistic 15% and alternative is 5%. So this is the on the basis of type of property which they have done. Result after 5 years, portfolio value is 280 crores, 40% appreciation, annual income yield is 7.2%, overall IRR is 14.5% and the best performing has been industrial logistic, that is 21% IRR. So this kind of portfolio can be created and there can be difference of opinion. Somebody might have given more weight to residential, somebody might have given more weight to industrial logistics. So depending on which sector they have strategically planned for, so this kind of allocation can be done according to your own choice. So this is the systematic approach which we are talking about. Then we have a case study of COVID-19 portfolio repositioning. So pre-pandemic allocation, office in the portfolio was 45%, retail was 30%, residential was 15% and industrial was 10%. So strategic response of the investor is that they have reduced the retail exposure from 30% to 15%, increased industrial allocation from 10% to 25% and added data centers 5% allocation which was not present earlier and enhanced the tenant diversification. Result is that portfolio value increased 30% over 3 years, demonstrating the value of strategic repositioning during market disruption. Here you should note that it is strategic intervention and not tactical intervention because COVID-19 was a big event. So many have done this, that they have reduced their retail exposure, some have reduced their office exposure and have increased their exposure towards the industrial or warehouses and the data centers, which are said to be a long-term like trend which is being seen in data centers. So that kind of approach has which is long-term in nature, will be strategic and not actually which will not be actually tactical. Then implementation challenges. So real estate has a specific constraints. So for example, there is illiquidity. If you want to change your portfolio, you want to get rid of something or you want to add something, it will take time. So for example, 3 to 12 months transaction timeline, that's a significant timeline. Many things can change in between that. Indivisibility, you cannot partially sell your properties. In share, for example, if you own around 1000 shares, you can sell it in different parts. So for example, you can also sell 1 share, you can sell 10 share, 100 share, but that is not possible. You cannot sell your drawing room, your kitchen separately. You have to sell your whole unit together. So that kind of indivisibility is there. Then high transaction cost. There is a lot of many duties, many taxes which are there from stamp duty to other type of taxes which are there. So that will extra charges which will cost you around 8 to 15%. So you can add it to your cost and then realize the final cost, because they are significant part of real estate transaction. Then heterogeneity, we understand that many times that the two units are not same. So that also impacts your portfolio. And valuation uncertainty, subjective appraisal based valuation. So you may find a valuer who will give you value of your property something, say for example 100 crores, and if somebody else get a valuer, they might value their the same property which is yours, and they want to buy it, they might quote it at 50 crores. So there can be a lot of variation because of the subjectivity of the opinion. So that valuation uncertainty is also prevailing in this sector. The solution is the emphasize the strategic planning, patient capital and long-term perspective. So that is why strategic planning works more here in comparison to tactical moves. Then Indian market considerations. We have to see that we have RERA implementation impact which has been felt by the sector a lot. We have seen the regulatory environment continuously evolving. RERA implementation has improved transparency but created compliance complexity. We have GST implication for property transactions, so that has also caused property to the whole process has been affected by this, and it vary by state and property type, and so you have to take that into consideration. And then we have foreign investment regulation limits certain type of investments there, and then state specific stamp duty variations can significantly impact the transaction cost. Then market characteristics present additional challenges. Data transparency limitation means you often have less reliable information than in developed markets. Informal transaction elements still exist in many segments, complicating analysis. Then varying development regulation across state create different risk profile for development projects, and infrastructure development impact can dramatically change the property values both positively and negatively, making location analysis crucial but complex. So these characteristics, all these don't make portfolio management impossible, but they require adapted approaches. This include building local market expertise, flexible strategies that can adapt to regulatory changes, and emphasizing relationship-based deal sourcing and conducting enhanced due diligence to compensate for limited data availability. Then optimization technique. So we have modern portfolio theory adaptation, helps optimize real estate portfolio despite the unique constraints we have discussed. Constraint optimization reflect real estate realities by incorporating minimum lot sizes, geographical constraints, and liquidity requirements into optimization models. You can't optimize purely on mathematical grounds without considering practical implementation constraints. Then we have scenario-based analysis, replace single point estimate with multiple potential outcomes reflecting the uncertainty inherent in real estate market. This approach considers various economic scenarios rather than assuming a single expected return. Then we have Monte Carlo simulation, models uncertainty by running thousands of potential scenarios, helping understand the range of possible outcomes and the possibility of achieving target return. Then we have risk budgeting, which focuses on contribution rather than just capital allocation. So this approach asks how much risk is each investment contributing to total portfolio rather than just how much capital is allocated to each investment. So that kind of budgeting question comes in. And then equal risk contribution, which approach basically tells us that it ensures that each investment contributes equally to total portfolio risk, creating more balanced risk exposure across different investments. And then we have active risk monitoring and adjustments. So in this, it involves continuous assessment and adjustment, which can be there based on the changing risk profiles and market conditions. So these techniques help create more robust portfolio that can adapt to changing market condition while maintaining disciplined approach to risk and return optimization. Then we have rebalancing strategies. So rebalancing real estate portfolios require creative approaches given the implementation constraints we have discussed. So we have new capital deployment, direct new investments towards underweight segments. Rather than trying to sell existing properties, this gradually brings allocation back to target without transaction cost of selling. So this can be one approach. Then strategic disposition, plan property sales based on portfolio needs rather than individual property performance. So if you are overweight in office properties, you might sell your weakest property even if it's performing adequately, right? Because you have decided, you have taken a decision that office because of the COVID-19, and you think that this work from home culture will remain and ultimately it will impact the office space in India. So you decided that you will decrease your office properties weight. So you have decided that, okay, the weakest performing office property in your portfolio, you will sell that. So that kind of balancing can happen. You have strategically you have done the disposition. Then you have property repurposing, change property use to shift exposure. So that can also be done, converting office space to residential or retail space to warehouses. Though this requires careful market analysis and regulatory compliance, because of course this cannot be done in isolation without looking at the local rules. There is a master plan, and some property types are not allowed in some type of areas. So it's not that easy, but if it is allowed, you can always think of doing that. So for example, going from retail to mall to maybe some other type of utility for that building, or specifically in some parts of that building you can start offices. So depending on the kind of options which you have in this repurposing, you can do that. Then structured partial exits, so use refinancing or joint venture to reduce exposure. You can partially sell your stake to reduce without full property sale. So you might sell a 50% stake to a partner, maintaining the management control while reducing the capital exposure. Then you can go for rebalancing triggers, which should be predetermined to avoid emotional decision making. This includes value drift, when allocation moves significantly from targets, market cycle changes that alter strategic outlook, liquidity events, when capital becomes available, and regular strategy reviews on annual or biannual basis. So these type of decisions you can take to rebalance your portfolio in real estate. But basically what it will require is your patience and your creativity. Then only you can use any of these strategies. Then best practice, if we have to summarize all of them. So establish clear investment objectives and constraints, develop strategic allocation based on risk return analysis, implement diversification across multiple dimensions. We have seen all the dimensions of properties. And then balance quantitative analysis with market expertise. It cannot only be quantitative, it has to be a market qualitative analysis. And then ongoing management, so regular performance monitoring and attribution, systematic rebalancing based on predetermined triggers, continuous market research and opportunity identification, and then technological utilization for enhanced decision making. So apart from portfolio construction, these ongoing management has to be there. Then only you will achieve best from your portfolio. So key takeaways: portfolio thinking significantly enhance the real estate investment outcomes. Diversification across property types, geographies and strategies is essential. Strategic asset allocation drives 70 to 80% of long-term performance, right? And regular monitoring and disciplined rebalancing maintain the alignment with the objectives. Technology tools enable better data-driven decisions. Indian market characteristics require adapted approaches. Implementation challenges demand patience and strategic planning, and risk management extends beyond traditional volatility measures. You should also include all the tools which we have discussed, whether it is your simulation tools, whether it is your the sensitivity analysis. So all these should be included. All the new methods which we have been learning, they should be included as part of the analysis of your portfolio analysis, because then only when you are keeping aside your emotions and using all these systems which have been proven and have been used all throughout the world, then you will be able to take better decisions. But of course, your qualitative strategic thinking will definitely play a crucial role in that, because how you view the future and how it will pan out, that will definitely be important in this decision making regarding your portfolio. So real estate portfolio management essential. Understanding risk return relationship. Foundation is that strategy, implementing diversification across multiple dimensions. Execution will be balancing analytical rigor with practical market constraints. Management, ongoing monitoring, measurement and optimization. Adaptation will be responding to market changes while maintaining strategic discipline. It should not be tactical, but it should be strategic, because there is a lot of transaction cost also in the real estate. So it has to be strategic and not tactical. So all this will combine to give you a successful real estate portfolio. Thank you so much.